In this video, we are going to be looking at document number A or document A of SAICA November 2019, the pre-release information. We are not going to be looking at B, C, D, and E. However, our main focus will be on the introduction or the welcome. And the welcome document, it's about everything that you need to know about the company. And also, as we look at this document, I am going to emphasize to you that knowing the competitor on day one is not important. Knowing the competitor is going to be important if the information that you are provided in B to E, it wants you to have a snapshot of how other companies are presenting or how other companies are basically showing in their financial statement particular information. For example, it could be a note or it could be accounting policy. However, the welcome information, it generally gives you all the information that you need to know about the company. It is for that reason, it is not important for you to spend so much time reading information about the competitor. Knowing more information about the competitor and not knowing the company that you have been provided by SAICA, it is a waste of time and it might cost you in order to do well in your APC. Now, let us look and see what we have in document number A. As it's already been said here, it is a welcome document and it's about Oikos presentation to Azania Bank or Azania Investment Bank. The information about the company is Oikos Property Group. Then here's the document A, and document A says welcome email from the Chief Executive Officer to a newly qualified CSA. The newly qualified CSA in this case, it is you. You are a newly qualified CSA. Hi there, welcome to Oikos Property Group, Oikos. We are very pleased to have a newly qualified CSA join our group. You will no doubt bring some great financial skill to the party and we will hopefully teach you a lot about the retail property market in South Africa. So what do you see here? Now the company is in the retail property market space and specifically in South Africa. As discussed with you during our interview, Oikos is a family-controlled property group whose aim is to keep expanding through acquisition of the retail properties. So what you see, what they're looking forward to do in the next year to come is to expand through acquisition. We do not invest in suburban or high street shopping centers and malls in major city. Rather, our focus and skill lie in identifying high yield retail property in small cities and towns, and preferable properties that are closer to commuter networks. So what is also important here is that their main focus where these properties are located, they are no near to the suburban or high street shopping center. However, they are next to high yielding retail properties in small cities and towns. So they're telling you that just to know by now, they are not in the places like your Cape Town CBD, or they're not in places like your Century City, like the big towns. However, they are located in the small areas. So when you're talking about small areas, if you are from KZN, places like Umzindo, or maybe places like Okailisha, if you are in Cape Town, and as well as maybe Soweto if you are in Joburg. So depending where you are, think of the places that are more of township sort of. So that is where they are generally based. They are not based in the suburbs or the major cities. And when we move down, to provide you with more background information regarding Oikos, I attached a copy of the PowerPoint presentation I gave to Azania Investment Bank recently. The slides should provide you with more context about our strategy and property portfolio. Please review and let's chat in due course about your role at Oikos. We look forward to the journey with you. So now what can you gather here is that you are going to be provided a PowerPoint presentation, and this PowerPoint presentation was prepared for Azania Investment Bank. So as we see this information now in your mind, you're asking yourself, why did they provide this information to Azania Investment Bank? It's most likely that they wanted the money, and that money was to be used in order to make either acquisition of the investment property, which is also what they are doing. The slide should provide you with more context about our strategy and property portfolio. Please review and lectures in due course about your role at Oikos. We look forward to the journey with you. P.S. When you read section 12 in the slides, specifically the point relating to the introduction of the free Wi-Fi in all our shopping center by June 2020, please start thinking about the key matters that will need to be addressed to ensure that the free Wi-Fi project is a success. This is as I have taken the liberty of monitoring you to the task team, and that will oversee the role of our project. So now, as you see here, this is a trigger. So this is something that you need to look at. I know most of information about the trigger will be in the document B2E. However, here you are told that you have been put into the task team. And the task team is to make an assessment of the success of the free Wi-Fi. Now, in your mind, you know that what you need to do is to understand if there is any company that is in the retail property market that is providing free Wi-Fi. Assess the challenges they're experiencing. Assess the good things about it. So the good things as well as the bad things in terms of deciding to go ahead and have free Wi-Fi in all the company's shopping center. So you need to understand that before you go to the exam. You cannot risk yourself to go in the exam without knowing this information, because you have already been told that you are part of the task team. You have been nominated to be in this task team. And as you get into that task team, you have to contribute. Your contribution is valuable, obviously. For that reason, the candidate here was expected to do research about the free Wi-Fi project to be a success. And you know that the company expected to have this project done by June 2020. So that takes us to the end of this page, and then we are going to move to the attached email. In the attached email, we know it is a slide, and then this slide was a presentation that was provided to Azania, right? Now let us move down. And when we move down, what do we see here? We have been provided information from 1 to 12. And when we're looking at all that we have here, we provided Oikos strategy and focus. We are provided their shareholders, our directors and management team, our top 6 properties, summarized property portfolio, top 10 tenants by GLA, our business model, the key risk, summarized financial statements, the consolidation, the financial strategy, benchmarking against our competitor, as well as strategic objective initiatives. So we'll go through all those 12 documents and read and understand the important information that we can gather from the documents that we are provided. By the look of things, all the content will give you all the information that you would need to successfully answer the questions in the exam. For that reason, again, candidate, please do not stress yourself about looking at the entire integrated report of the competitors. You will be spending a lot of time which you should be reserving and understanding all those documents and doing proper research based on this document. Do not spend a lot of time reading the integrated report of different competitors, which will not be useful in successfully answering the questions. Your success in being successful in APC, it is highly dependent on how good you have understood the information you are provided during the previous information. Now, without wasting time, let us look at all those documents that we have or the content of those documents. Looking at Oikos strategy and focus, Oikos is a privately owned property group which acquires and invests in the retail property. We specialize in the retail properties in small cities and rural towns that cater for lower LSM market. Oikos acquires properties and lists this to tenants, mainly retailers, who focuses on shoppers who purchase groceries, other necessities, and fast food on their way to work or home. Our retail properties are purposefully situated close to commuter networks such as taxi ranks and train stations. So now, what do you understand based on the information that you see or you have been provided here? They are emphasizing again that they are looking on the small cities and their focus is on the lower LSM market. And what are they doing actually? They acquire and invest in the retail property. And they have tenants, and these tenants are retailers. So that is the most important thing for you to understand is that this business, they acquire properties, and then once they've acquired this property, they then rent them out to the retailers, which means their main revenue, it will be the rental income. So everything surrounding rental income is very important for them. Now let's just move down. Our shareholders. Who are the shareholders of the companies? If you're looking at the company, you can see that the majority shareholder, in terms of percentage, is Njeke Family Trust. And we are told that more information about Njeke Family Trust we will get under A. And then B, it's Yvonne Njeke, who is the CEO of the company and also owned 15% shareholding in the company. And then we have Gideon Madima, who is the CFO. CFO owns 10%. And we have Hope for the Children Trust. And the more information for Hope for Children Trust we will get in C. And they also own 10%. Now, you've been told that this is a family company or family orientated company. And by that, you can see that the family potentially owns 65% plus 15%. And the 10% might also be more of a family. Now, let us read the note which explain more information about the trust in JK or Yvonne, as well as Hope for Children Trust. If you're looking at the notes, they're saying Freeman Jagge founded Oikos Property Group in 1999 and made his family trust the controlling shareholder at the inception. Now it makes sense why they have 65% because when Jagge founded or when Freeman founded this company back in the 1999, they decided that the controlling shareholder of this company will be the trust. All right. And then we know the company has been around for many years. It has been around for more than 20 years by or as of 2019, or almost 20 years as of 2019. Yvonne is Freeman's daughter and succeeded the father in 2017. So Yvonne just joined the company. So Yvonne joined the company when you're looking at 2019 point of view, because remember, this is a 2019 paper. Yvonne has recently joined the company as the CEO. Hope for Children Trust is a non-profit organization that provides bursaries to underprivileged school-going children. So this is a trust, and the main purpose of the trust is to provide bursaries to underprivileged school-going children. So now you have all the information that you need about the shareholders of the company, and you know the major shareholders. It's a trust, then followed by the daughter of the founder, and then we have the CFO as well as the trust. So all the information that you need to know about the company in terms of also when it was established and when did the CEO of the company change, it is here. It was established in 1999, and also the CEO of the company changed to become the daughter of Freeman as of 2017. Now, when you moving down, it gives us information about the directors and the management team of the company. We know that the company, we have not been told whether it lacks or it would like to comply with the King for recommendation. However, in an ethics types question, if you see that the composition of the directors is not in line with the recommendation of the King 4, you need to raise that in the questions that are regarding the ethics, because you will earn marks by showing the examiner that you know that even though they are not they are not planning, or they are not listed on the JSE, they still need to consider the requirements of the King 4. Now let's look at what we have here. In terms of directors, we are given Freeman Njeke, and we know Freeman Njeke is the founder of the company, and we're told that Freeman is the chairperson of the company. As we see that Freeman Njeke, as the founder of the company, lacks independent. For that reason, it is not correct according to the recommendation of King 4, right? Remember, no one said that they want to comply with King 4. However, you are realizing as you're looking at the information that even though this is a private company and they're not telling us that they want to, or they're planning to comply with King 4, but we know this is not right based on what we have read in the King 4. When you're looking in terms of the years of service, like 21 years, that means Freeman Njeke has a very good experience in terms of the industry operation, which is good. And when we're looking at Zandile Mkhize is a non-executive director, and Zandile has 6 years experience in terms of knowing the operation of the investment property companies. And then we're looking at Andile Matondi, non-executive director with 7 years experience. And then we have Yvonne Njeke, is a chief executive officer, he's a CEO. And when we're looking at the number of years of experience that Yvonne Njeke has, it's only 3 years. What would you say here? It is a bit concerning. And the reason it is concerning is because you're not expecting the CEO of the company to only have 3 years experience, because we know that the CEO of the companies are expected to have a number of years of experience so that they can lead and manage the companies well or successfully. Then when you're looking down, you're looking at Gideon Madima, is a chief financial officer with 5 years experience. 5 years experience in the industry. It is not bad for the CFO. However, you would expect maybe a little bit longer years for the CFO as well. And when you're looking at Lizanne Creel, is a chief operating officer with 12 years experience, which looks good. And then when looking at all the directors in it entirely, there were a total of 6 directors. If you can count together, it's 1, 2, 3, 4, 5, 6. And out of these directors, per recommendation of King 3, the expectation is that the majority should be non-executive. But when you look here, only 2 are non-executive, which now raises the concern in terms of the recommendation of the King 4. What else is a problem is that now, when you're looking at the non-executive, King says the majority of the 2 must be independent. So we cannot ascertain that because there's no additional information that we have here. However, we can just make assumption to say they are independent. We don't know whether both of them are independent or not by now. And then when you go down, they say Lisan is primary responsible for the retail property operation, managing Oikos property portfolio and leasing properties to the tenants. He's an operating officer, so it makes sense that he's obviously dealing with the operation of the company. Number 4 talks about the top 6 properties. In terms of the properties or the top 6 properties, we can see that they've provided us more information in terms of the name, the location, lettable area, as well as the valuation of the property. So if you can look at the top and the bottom, when you're looking at the top, we have East London, which is 3 Sallows Junction. 3 Sallows Junction, it is based in East London, and it has 6,808 meters squared, and it was valued to be 112 million, or roughly 113 million. And then we have Bay Square, and Bay Square is in Mbangeni, and Mbangeni is in KZN. And also, when you're looking at the size of the lettable area, it's a little bit bigger. It's sitting at 6,250. And in terms of valuation, it's roughly sitting at close to 112 million. And then there's St. Peter's Precincts which is in George, and George it is in Western Cape, and the lettable area it's 5,500 meters squared, and the valuation is roughly close to 90 million. And when you move down, there's Northview Center, which is in Port Elizabeth, and Port Elizabeth is also in the Eastern Cape. And then we're looking at 5,200 meters squared, and valuation size it's sitting at 76 million. And there's Aces Plaza, it is in Bloemfontein, and we're sitting at, in terms of lettable area, 4,990 meters squared, and the valuation is roughly 67 million. And when you're looking at Kusuba Mall, which is in Lusaka, it's 5,990 meters squared, and when you're looking at the valuation, it is valued roughly close to 60 million. So these are the top 6 properties that they have. You can see from here that most of their properties are based in the Eastern Cape, and we have in Mpumalanga as well, and also in KZN. And then when we move to number 5, you're told about summarized property portfolio. And here you are given information about the number of properties, average value per properties, gross lettable area vacancies, average monthly rentals, as well as average contractual rental escalation. So what do you do when you find information like this? Start calculating the ratios. And the ratios you're going to be calculating, it's only when you're looking at the increase. So why you want to do that? Because that will help you to answer some of the questions. Most of the qualitative in nature question, they require an understanding of the movement or the changes that are taking place in the company each year. And you can only calculate the changes that are taking place in the company each year by calculating the movement. So my recommendation to the candidate writing the paper of the similar nature is that's one thing that you need to look first. Number of properties. When you look from 2017 to 2019, there is an increase of 1 property each year. And when there's an increase of 1 property each year, what does it mean? If you are buying those properties using the loan, it means there will be an increase in the loan they have. That's number 1. And number 2, if these properties immediately once they are acquired, they are leased out to the tenants, then the rental income will expect to increase. So those are the fundamental things that I would think of when looking at the number of property increasing. And I know that when they buy properties, their main aim is that they rent or they lease them out to the tenants. So those are kind of things that I'll look at. How did they acquire it? Cash or loan? Number 2, how are they leasing them? Are they leasing them immediately, or does it take time before they can lease out? So those kind of information are important for you. So mainly you digesting information and trying to understand more information about the company. Then when you move down and look at average value per property. So average value per property each year, we can see there is an increase, and you need to calculate the movement because this kind of calculation might help you in answering some of the qualitative type question as you move along your exam in the exam. Now, when you see here, there is an increase each year. Why there is an increase each year? Number 1, the property value is expected to increase each year. We know that property value, it increases in value each year. So as the property value increases each year, then you're expecting average property value to also increase. Then we're looking at gross lettable area. The gross lettable area, it also increases each year. That is expected also because of the fact that we are increasing property each year by 1. And then there's a monthly, average monthly rental per GLA. So the average monthly rental per GLA, it is increasing each year. And the question is, why is it increasing each year? The reason it is increasing each year is because there are escalation of the rental income each and every year. Think of yourself when you're renting a property. The owner or the landlord will tell you that next year my property will go up by 3%, by 4%, whatever percentage they will give you, but you know that there will be an increase. So it's similar in nature then as them when they're leasing out to the retail companies or retailers. And then when you're looking down, it's average contractual rental escalation. So escalation is that additional percentage that of the rental amount that is added. So each year, it's reducing or it's declining. Now you ask yourself, why is it declining? Is it declining because the vacancies, when you see they are vacancy is going up? So now, as you see the vacancy going up, then you can link to the escalation. You say the reason the escalation might be going down is because they see the vacancy rate is going, the vacancies is going up. So now they're trying to make sure that people do stay in their property, right? So they're trying to assist the renters, or they're trying to assist these retailers who are renting to them to be able to stay in the market by not increasing the rent by so much. So, what is very important, as you see here, for you to better be able to do well in the paper is to understand the terms in the property market space. And what are those terms in the property market space? Are the terms like the vacancies? When you talk about the vacancies, it means what is the percentage of the property that is not rented. So let's just say they have 100 properties. So that means of the 100 properties that they should be renting out and receiving the rental income, 3.5% in 2017 was not rented. However, when you're looking at 2018, that number of unrented out or not rent property, it went up to 4%. That is not good for the company because it means they're not receiving sufficient rent because now they are 0.5% less compared to last year in terms of rental income. It even goes up further in 2019. And what do we see in 2019? It's now 4.5%. And when you see 4.5%, you're like, oh my God, that is even worse because it was better before. Now it's even 4.5%, another 0.5% less than what we would be earning in the previous year in terms of rental income. And when you move down, you can see now, you can now link why we would have escalation that is going down because they want to ensure that they are not, this number does not increase even further. So to ensure this number doesn't increase even further, the escalation, then they might need to be going down. So, which is why I'm saying spend so much time understanding the company you have been provided and the operation and the terms you've been given instead of spending time going to read at the competitors' information, which will not help you in the exam to be successfully. And then number 6, we are looking at top tenants by GLA. So, in terms of the size, gross leasable area, who occupies the bigger portion of their space? If we're looking at tenants, they have Spar Group. Spar Group is taking 9.5%, which is the largest. And we have Shoprite Checkers, which is 9.2. There's Pick and Pay, which is 8.5. There's Pep Stores, 7.5. There's Boxer Superstore, which is 4.5. There's Ziggy Beggars, 3.4. There's Cashbuild, 2.9%. Mr. Price, 2.2. Fortune, 1.8. And then there's Jet Stores. So now as you look at this information, what is more important to you? As you look, you can confirm that they are the information that is provided to say they focus on the lower LSM size, people who are not upper middle class or even affluent. You can see from the shops they have Spar Group. They don't have shops like your Woolworths. They don't have shops like your Checkers, which are obviously those shops that are well known to be covering higher or medium LSM. And then you can see even they have Cashbuild, they have boxes, which are also shops that are normally servicing or normally where you find buyers to be people who are lower earners or lower middle class or even lower. And then, so that's the information you've been provided here. There's nothing much you can consume from this except that it gives you more information in terms of the clients they have or the people that are renting to them. And then when you move down to number 7 gives us the business model. So the business model about the company, already you know that they are in the property market. So we are given property portfolio in a nutshell, and we're told that there's a leasing of property and renewal. When you see leasing and renewal, that is the main business operation of the company. So you are expecting the company will be leasing out the property and also renewing the contracts for the current renters or the current tenants. And then there's purchase of retail properties. We have seen that each year they're increasing property by one. As you see that increase of property by one, it does make sense to you to say, oh, okay, because you've been told that they are increasing the property by one. So now they need to be purchasing those property. Now there is a division that deals with the property purchase. Upgrade of properties. Each and every property might need to be upgraded at some point. You cannot expect the nature of the property that was in 1999 is still relevant now when we're looking in the 2000 some change. Now, for that reason, we're expecting that there will be some upgrade of the property as and when required to be appealing to the next renters. So in that case, they will have a division. You expect them to have the division of that nature. And they have the supporting divisions. So what is the supporting division? It will be the finance and administration. So what is finance and administration doing? The finance, obviously, they're working on the financial statements. They're administering in terms of the rents and all those things. They're making sure that the company pays the tax over to SARS, all the finance and administration types of work. And then there's marketing activities. Remember that each and every company need to market themselves in order to be known by their clients. So they need to market themselves so that they are known by people who will wish to be their tenants. So they have marketing activity, which is also a supporting division. And there's a credit assessment and ongoing monitoring of tenants. And also that division, the main purpose is that they are there to ensure that if there's a new tenant that need to be enrolled, they need to do credit assessment to see the kind of that tenant. Do they normally pay their rent? If they don't pay their rents, they wouldn't want to associate themselves with them. And then ongoing monitoring of tenants also to ensure that they are paying and they're paying on time. If they're not paying, they need to know what are the challenges the tenants they might be experiencing. Then we moved on. They're saying Oikos outsources the property management operations. Day-to-day operations such as facilities, plumbing, electrical and other repairs, rental collection, metering and invoicing of utility cost, details management reporting per property, etc. to reputable and experienced third party. So as I look at this information now, you know, Guti, they're not doing everything. So some of the services they're not doing in-house, but it is done by the third party. And we're told what the third party is doing. It is rental collection, metering, invoicing, plumbing, and electrical. Number 8, it takes us on the risk, the key risk that the business is facing. So it is important for you to understand each and every business will have the risk. And by you being provided the risk, it gives you an idea. What are the kind of triggers that might come when we move to other documents which have triggers? Now, the major business risk Oikos faces is increasing vacancies due to limited economic growth, increasing unemployment, and changing consumer spending patterns. So, what does that mean for you candidates? So, you have realized, or rather, must I say, you have seen as we're looking at the documents above that there is an increase in vacancies. It moved, but it's keep on increasing by 0.5% each year. So now they are telling us that this is the risk that the company is facing, and this is due to the unemployment rates and the changing consumer spending pattern. So remember that if they're renting out the property to their tenants, they're depending on the consumers. If there are no consumers, they might close their business or they might negotiate their rent. They cannot stay in business if the consumers are not coming to buy their products or they're not coming to buy whatever they're selling. So if the unemployment rate increase, it means that people are at home. They're not going to the shops. So if they're not going to the shops, there'll be no money that is made by the tenants. And if the tenants aren't making money, so what does that mean? It simply means that if tenants are not making money, then they are tenant. If the consumers are not making money, they are not going to be buying from tenants. And if they're not buying from tenants, the tenants will struggle to make payments for the rental. And also, consumers, as they see the economy is not doing well, they might decide not to buy certain things. And by them not buying certain things from our tenants, it means that we are running a risk of losing the tenants. Then the rising interest rate and the adverse impact on the group's gearing levels and cost of funding. So what does it mean? It's most likely that even the banks, because of the market outlook, they might increase the interest rates they are giving to Oikos. We don't have much information about that now. However, we're just thinking what will be the reason for the rising interest rate? The banks, when they're looking at how you're doing as a business, they might decide to say, now you are more riskier than you were last year. Therefore, the interest rates I'm going to charge to you, it's going to be a little bit higher. Or they might be looking at the market outlook and say, when you're looking at the markets, the company that are in the property space, they are not doing so well. For that reason, because you are also in the property space, we are going to bill you, or we can also charge you more money. So things like that are very important for you to understand. And then underperforming of third-party managers. We have been told that some services from the above, they are done by the third party. That includes billing, collection of rental, other managements of property and reporting, as well as plumbing and electricity. So now they are saying, in collection of rental, inaccurate invoicing of utility, cost and upsetting the tenants. So now they're saying that tenants are not happy because of this third party agents, because they are sending incorrect bills and also inaccurate bills, so that the tenants at the moment are not happy. Non-compliance with statutory laws and regulations. So what will this company of this nature be not complying with? They could be not complying with the rules, with the laws and regulations surrounding their books, mainly them not paying over to SARS the tax, or them not complying with Companies Act, or it could be matters of the industry specific, thereby they're not complying with the laws and regulations surrounding the property market investment. And then the risk of the IT system failure and the cybersecurity. So what do we see now when you're talking about the IT system failure as well as the cybersecurity breaches? That means the IT environment is not strong. So there are some loopholes that poses the risks to the company. And as you see that, you're like, oh, okay, cool. Now I understand that there is a risk then surrounding the IT system of the company. And at this point, now, when you're looking even in 2019, the IT is very important to ensure that it's strong, so that the company ensures that it complies with the requirements of POPIA. When you're looking at number 9, we have summarized financial information. Now, when you're given summarized financial information, what are you going to be doing? Calculate the important ratios for the company, analyze the trend, check how the changes have happened from 2019, 2018 to 2017 to 2018, 2018 to 2019. So you look at the trends and calculate the important ratios that you believe are important. So why am I saying calculate the trends and ratios? It might not be required as a question. However, some qualitative questions might need you to use those ratios to justify some of your answers. So we are given information about the rental income. Looking at the rental income, it increases each year. It is expected to increase because of the escalation that is happening, as well as the fact that they are adding one property each year. And then property expense, overall, we see that it increasing. All the expenses, they're increasing each year. And the reason they're increasing is because we are expecting that there will be escalation from the providers of the services. And then operating profit is still increasing each year, which is good for the company. When you move down, we're still given more information about the profit, the statement of profits and loss. We're seeing the fair value adjustment, and there is a star next to it, and they're saying this fair value solely to investment property. So this fair value investment is relating solely to the investment property. And what do we see? We see an increase. When you say an increase from 2017 to 2019, it was a big increase. And then when you look at 2018 to 2019, the fair value went down. So a bit concerning why it went down. You would like to know why it's going down. But obviously, there's nothing that triggers you to know that. You just see as you calculate the trend that there is a decline from 2018 to 2019. Earning before interest and tax, there was an increase in 2017 to 2018. However, there's a decline from 2018 to 2019, which obviously is a bit concerned because you would like your earning before interest and tax to be fine or to be increasing each year because there are escalation in the rental income. So now your question is why there is a decline. A decline obviously is also contributed by the fair value adjustment. Now you're looking at the interest income and funding charges. We need to analyze that in isolation. The interest income comes from the balance of investment that you have, and the funding charges it's coming from the balance of the loans that you have. When we're looking at the interest income in 2017 to 2018, what do we see? We see an increase. However, there is a decline when you look at 2018 to 2019, meaning to say the balance of investment the company has reduced. So you would like to know why is that the case? If it's not the case, remember the interest income is made up of the balance times the rate of income that you get or the percentage return that you get. It might happen the percentage return has reduced. So those kind of questions you popping in your mind just for understanding. You see that the operation of the company was doing well from 2017 to 2018. However, when you look at 2018 to 2019, there seemed to be a decline in some of the income of the company. Funding charges, when you look at the funding charges, it keep on increasing each year. So you are not happy to see the funding charges increasing each year because what does the funding charge increase means to you? It means that the interest rate that we are billed, it has went up, or the balance that we have, it has went up. And then you wouldn't like to see the company having more debt as opposed to the income. So that raises a concern to you to say, no, 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 no. Why the finance charges are going up while the income or interest income is going down? That is not something that might make the company happy. You'd like the company to be experiencing. So the kind of question that you will be looking at is like, oh, I'm not happy about what I see. But obviously there's no more information that you need to digest on this except that consuming it and keep it at the back of the mind. Before taxation, normal taxation. When you look at the normal tax from 2017 to 2018, we see an increase, as well as the following year, there is also an increase. So now as you see that this is increasing each year, you're asking yourself, why if my profit before tax is going down, but my normal taxation is going up each year? So that's the kind of question you also ask yourself because you're a bit concerned about it. Because your expectation is that your normal taxation, as the profit goes down, it's also going to go down. But in this case, we do not see that. Deferred taxation, the deferred tax each year from 2017 to 2018, what we see an increase. However, when you're looking at 2019, there's a decline. A decline is expected because the fair value adjustment went down here and also the profit is not doing well. Then the profit for the year, it has increased from 2017 to 2018. However, when you're looking at the prior year versus this year, or 2018 versus 2019, we see a decline. So it is a bit concerning overall when you're looking at the decline. What decline did we see? We see a decline in fair value adjustment, we saw a decline in interest income, and now we see a decline in the profit for the year. So those decline are things that are not making us at ease as the new joiner of this company. Now let us look at what comes next. We're still on number 9, which is our summarized financial information, and this is the consolidated information. So what is presented to us now, it is a statement of financial position as at September year end. So we are given the same information, which is 2017 audited, 2018 audited, and the 2019, it is a draft. Now let's look at all the information that we have and digest further. We are provided non-current assets. Under non-current assets, they have 4 items. They have investment property. You are expecting to see investment property because of the operation of the company. They are in the investment market space. We have office equipment. There is a goodwill of Lusaga LCC. As we see the goodwill of Lusaga LCC, you're like, oh, okay, cool. That means they've once made an acquisition of Lusaga LCC, and they recorded goodwill when they were making that acquisition. Then there's an operating lease asset. So those are the 4 non-current assets the business have. Now let us analyze each year and see what is happening. If you're looking at the investment property, each year is going up. Why is it going up? The 2 things that result to the investment property going up is because of additional investment property acquired each year. We've seen that they're acquiring 1 asset each year. And then also because there is a fair value adjustment. So now you see, okay, the investment property is going up each year, and then you see what is happening. And then we see office equipment. Office equipments, there is a decline from 2017 to 2018. That means there were no additional acquisition, only the depreciation maybe that was taking place. You're just making assumption. You're not sure what is happening. Those are just assumptions. And then when you look at next, then there's an increase, meaning to say probably made acquisition of the office equipment. And when you're looking at the goodwill each year, what do we see? We see a decline each year. That means potentially there is an impairment of goodwill. Then you would like to know why they're impairing the goodwill of Lusaba LCC. Probably Lusaba LCC is not doing so well. We don't know. We're just making assumptions based on the numbers they are providing us. And no one said this is a trigger. It's just for you to consume the information that is presented to you for the benefit of doing well in the exam. Then there's an operating lease asset. When you're looking at the operating lease asset, what do you see? From 2017 to 2018, we see an increase. And then from 2018 to 2019, we see an increase of the operating lease asset. Now we're going to move to current assets. What do we have in the current assets? In the current assets, they have provided us three assets. And the three assets they've provided us, it's a trade and other receivables, it's operating lease assets, as well as cash and cash equivalents. So as you look at the trade and other receivables, looking from 2017 to 2018, what do we see? We see an increase. And then from 2018 to 2019, we see an increase. Would you like, as a company, to have an increase in trade receivables? The answer is no. Why you wouldn't like to see an increase in trade receivables? Because that means the renters, the tenants are not paying, and the amount that they have not paid, it is therefore sitting in trade and other receivables. So it is a bit of a concern to see trade and other receivables going up for the company. So you keep that in mind. You can even in your preparation write down that this is your concern so that you would easily remember when you go to your paper. Then operating lease asset. When you're looking at the operating lease asset, you see each year there is an increase, and then the cash and cash equivalent. Which, when you look at 2017 to 2018, there was an increase and the company was happy. However, 2018 to 2019, there is a decrease from 27 million to 16 million. And that is a concern for the company. And the reason this is a concern for the company, if the bank balance of the company decrease, it means the company might not be able to take on some of the short-term investment for the company. And they might not be able to pay their debts, short-term debts, as they are failing due. And then what is also thing that might be resulting to the cash and cash equivalents going down is because of this increase of trade and other receivables, because it means the tenants are not paying. Then overall, the assets are going up for the company. Then when you move down, we are given share capital and reserves. Non-controlling interest, we see an increase in 2017 to 2018. However, there's a decline in 2019. And then we're looking at the non-current liability. The company have three non-current liability, which is interest-bearing borrowings, deposit received, as well as deferred tax. So when you're looking at all this information that is provided to you, what do you see? Interest-bearing borrowings. It has went up from 2017 to 2018, but we see a decline in 2019. When the borrowings goes up, it means 20 in this year, they decided that they were gonna borrow money from the bank. But however, here probably they made some payments of the loan that they were owing in the previous years, which is something I would say it's good on my side, but it might happen that it's not good if the company want to expand more or they want to invest more using the borrowings. Deposit received. When you're looking at the deposit received, each year we see an increase each year, and then deferred tax, we see an increase each year. Then we're gonna move down to current liability. The three current liability, trade and other payables. Each year we see an increase. It means that we are not paying our creditors on time. It might mean that now they're going to start charging us interest, which sometimes this is good or bad. It is good if it's because you are negotiating with them and they're happy with our negotiations, but it's bad if you're not paying because we can't pay and they're now starting to charge us interest. Interest-bearing borrowings. So these are our short-term repayments that are due less than 12 months. What we see here, we see a decline each year. It is good to decline because that means our balance has declined, and we see the balance has declined anyway here. Taxation, we see an increase in taxation. This might not be good because we know SARS charges interest because of late payments, and they also charge penalties. And then here, Oikos Group, September year end. So here we're only given 2 years, and then they're giving us further breakdown of the income statements. So what we see here is profit, operating profit, which we've already seen, and then depreciation information, straight line rental, income adjustment, foreign currency translation. So you'll ask yourself, why do they have this? And then there's interest income, which is going down, finance charges, which is going up, taxation, which is going up, working capital charges, which is going down. So then they're giving us net cash generated from operation. So this is like a cash flow statement. So that's why you see this information. And then acquisition of investment property. So there was 54 million and 51 in the current year. Acquisition of office equipment, it's minus 90, minus 105. So we see the more increase in the 2018 to 2019. So now we understand it's because of this acquisition. Then deposit received, it went up, and then interest-bearing borrowings, it went down. And the movement in cash for the year. So if you see the movement here, it was positive, here it's negative. So which is not good for the companies. I've already said the company would like to have more cash, but here seems like the cash is going down. Then summarize financial information. Now they're giving us more information that you need to know about the financials of the company. Some notes of the summarized financial information. Goodwill arises on the acquisition of 80% of Kasuba LTC. A Zambian property company, goodwill has never been impaired. So they're saying goodwill has never been impaired, but we saw goodwill going down. So that is a bit concerning. You want to understand if goodwill is going down, what is happening then? Oikos early adopted IFRS 9, IFRS 15, and IFRS 16 with effects of the start of the 2017 financial year. Outstanding rental receipts are included in trade and other receivables, whereas operating lease asset relates only to straight line lease asset, lease rental income. And then they're giving us financial strategy. The Oikos Group uses interest-bearing borrowings to finance acquisition of investment property and to fund its operation. The group has well-established relationship with the major commercials and investment banks in South Africa. Oikos negotiates facility with local banks, usually on the following terms of the loans. Interest rate of less than the prevailing prime overdraft rate. Interest is calculated and paid monthly. The loan terms are for 5 years, and the repayment of loans is a single bullet payment at the end of the loan term. And the loan covenants that the Oikos must maintain a minimum interest cover of 2.5 times and the loan to value ratio of 45% at all times. Interest cover is calculated, and then they show us how to calculate the interest cover, and then also they give you the loan to value ratio in terms of how to calculate it. So you are provided formulas here, and you need to understand these formulas because you might need them. And please do calculate these ratios. Don't go to the exam. You wouldn't go to the exam without calculating these ratios. It's important to calculate these ratios and understand these ratios. This is not a trigger, but it is important for you in case there are some qualitative questions that you need to answer and they really need these ratios. And then when you move down, it's the benchmarking against the competitors. So you have been provided the competitors of the companies listed on the JSEs, which they believe they are their competitors. And what we've been provided the details for all the ratios that are important for this industry. They gave us gross leasable area. They gave us the total investment portfolio value, average value per GLA, vacancies as a percentage of GLA, average monthly rental per GLA, the interest cover, and loan to value ratio. And all the information have been provided here, and you need to compare Oikos with those other companies. However, you need to remember these are the big dogs. So these companies are big and they're listed on the JSE, and Oikos is just a privately owned company, not yet listed on the JSE, and it's just a family group. So now when you see this interest cover, now you can see this interest cover, it's already not in compliance with what is required per their loan covenant, which is now a problem. And then also just understand all this in terms of the market or in terms of the investment property market space, because it is very important for your understanding. And here we are given the strategic initiatives where the company want to see themselves in the 36 months. So research on which cloud-based property management software with integrated real reporting is the best in the market. Implementing this by 30 June 2021. Research into which retail properties focused on lower LSM group are part of the property group that may be forced to sell their asset to reduce the debt, to move swiftly to acquire quality asset and make and have banking facilities available to execute. Introduce the Wi-Fi for all shopping centers by 30 June. So this information we've already been given. Now it's coming again. And then reduce the vacancies to below 2%. We know they're currently sitting at 4.5%, and their target is by 2021 financial year, and grow operating profit to more than that of the competitors in the next 5 years. So let's take us to the end of is what is in the background information. And the next video, we are going to do the coverage of other stuff. And what we're going to be looking at the trigger documents. Thank you so much for listening up until this far. As you prepare yourself for the APC, I wish you all the best and goodbye. See you on the next video.